All right, welcome to Module 2, Uncovering Market Madness, Understanding the Market and the Movements. I'm Jason Whaling, founder of the Wealth Titans, full-time investor and entrepreneur. So welcome to Module 2. And in this module, we are going to cover the big picture of the markets. Now that we have an basic understanding of the markets and kind of how they work, we're really going to dive in and look at the markets to gain a comprehensive understanding of why it behaves the way it does. Really digging into why do the markets move up and down? Why do they move up and down so much? Some days it seems like it's a teenager with mood swings, and the other it seems like a grandpa just sitting in a chair. So let's dive right in. How are stock prices decided? Share prices change every day due to a countless number of market forces. With share prices changing multiple times per second with some stocks, it's important to keep up with the market movements as a non-professional. It's important, and it's also impossible. So this is when I say important, I should have clarified that this for traders. If you're trading, it's important to keep up. If you're investing, it's not important to keep up. Sorry about that. Of all the forces that move and manipulate the market, the rudimentary economic principles of supply and demand really are the strongest at the end of the day. When lots of people are interested in buying a particular share, the demand for that share goes up and the price of the share moves upward proportionately. When many people are selling a particular stock, the supply exceeds demand and the share price drops because there's more sellers than buyers. While it's easy to understand the basic principle of supply and demand, it's very difficult to find out why people decide to buy a particular stock and sell another. If you decide you want to learn to be a trader, this is really what you're going to be doing the majority of your time. The why is important to you as a trader and will be a large part of your trading plan and methodology. Because when you're trading, you're competing against other traders. So it becomes all about behavioral finance and understanding how other people are thinking and trying to predict their moves. For investors, it's a heck of a lot easier. The why isn't all that important since your focus will be on the operations and health of the company rather than what the current market sentiment is that's driving the current stock price. Now, we could spend an entire course attempting to list all the different factors that move the markets. So we'll just touch on three most common factors that influence non-professional investors to make their buy and sell decisions. As cynical as it might sound, professional traders are often on the opposite side of non-professional traders, buying when the public is selling and selling when the public is buying. And we'll look into how this works out in a bit. The easiest way to find out whether people are going to like or dislike a stock is to review current news about the company of the stock. If any news is favorable to the company, then the positive sentiment will most likely be present in the market, pushing up the share price. However, when news is adverse to the interests of the company, the negative mood will set in and the price of the share may come down. Now, there are different times where the good news and bad news won't move the stock at all, and that's because people already assumed the news was going to be bad, and so the market has already moved on that bad news, and vice versa for good news. This is true because in the short term, news developments have the greatest impact on share prices, and you can use this to your advantage without having to learn any complex or convoluted chart patterns. Now, this may seem like an oversimplification of determining how the general market moves and what the sentiment is. However, the reality is, unless you devote hours a day understanding the full implications of the driving factors behind a stock's price movement, this is the most practical approach. I do have a quick warning to aspiring traders. Here's the harsh reality you and I face as traders. Professional traders will be in and out of a trade by the time the news comes on. The professionals set their trade before any news reports hit CNBC or Bloomberg TV. In fact, they use news to exit their trades. When the general public decides it's a good idea to jump in, they pay thousands of dollars a year. The professional traders pay thousands of dollars per year for news sources that will give them the inside scoop before anything hits the TV, in addition to their great knowledge base of how to do in-depth research to beat the news stories, which keeps them a step ahead of the general public. For this reason, if you plan on trading, don't expect to strike it rich trading the news. Next, we have company earnings. One of the major news items that an investor and trader should watch for, more so trader though, just short-term investors sometimes watch for this, is company earnings reports. Earnings are normally reported on a quarterly basis, and these companies release these quarterly financial statements, and then one big one at the end of the year. The price fluctuation of a stock's price will peak during the periods where traders anticipate good news or bad news on these earnings. And these are sometimes called earnings plays, where traders will look and try and predict what the earnings are going to be, and the market price will fluctuate a lot around those times. Now, in most cases, the company's earnings announcement is only half of the picture. The earnings numbers only matter in the context of analyst estimates. However, the reports are only the result of the end of a big guessing game, because the real driving force behind the stock's price around the earnings is the analyst expectations of the earnings. So when a company says, hey, we're up 500,000, that 500,000 is only good or bad in the context of analyst earnings. If analysts think that they were going to be up 700,000, then it's bad news. If analysts thought they were going to be up 300,000, then it's good news. So just keep that in mind. It's what they call earnings plays. When traders play earnings, they are looking at analysts and saying, what is the expectation? And thinking if the expectation is going to be right or wrong, as opposed to whether or not the number that comes out is actually good for the company. All right. And finally, we have analyst projections, which is very similar to what happens with earnings. Analysts usually predict the amount of profits or losses that a company will make. These predictions are the real driving forces behind the stock's price movement around these earnings. This often results in a strange phenomenon. More often than not, when a company meets its earnings projections, little happens because the expectation of positive results has already been factored into the stock. Those who bought were just waiting to be right, or sell to those who are buying at the last minute before earnings are announced. On the other hand, when a company's earnings fall short of expectations, even if it's just a couple of pennies, and I mean pennies, sometimes just 1 penny, the price may drop like a brick just because expectations weren't met. And this brings us to volatility. So what is volatility? And this word volatility is most arguably the most overused word when it comes to financial news. Simply put, volatility is a measure of how much a stock's price moves. It's just a measure of price fluctuation, how it goes up and down. The higher the volatility, the greater the typical price range or fluctuation of a stock. Since it's measured in different ways, I want you to think of volatility as the standard deviation of a stock's price. Remember that when you average data, the standard deviation gives you a measure of how accurate the mean or average is. So if the standard deviation is 2 and the mean of your data is 5, it means that the average is 5 plus or minus 2. In our case, we see that the stock price is the mean, 5, and volatility is the standard deviation, 2. So when you're looking at the price movement of the stock, as long as the price is between 3 and 7, it would be considered normal because both prices are within the volatility range. So this volatility range, or the trading range, would be 3 and 7. We expect the price to go between 3 and 7. If it breaks above 7, Then we have something called a breakout where we think, ooh, maybe something's really different and it's going to go higher. Or if we have go below 3, we think, oh, something bad came out. This isn't normal. So the 3 to 7 is kind of what you would consider normal. And by the way, a 3 to 7 price fluctuation for a stock is really high. So this is just an example. Volatility is not the same as risk as many financial sites and common people think. Yeah, that's a nice way to put it. Stocks that are more volatile are often considered more risky, but volatility itself is not a measure of risk. And that being said, this is just a giant misunderstanding. What market volatility really represents is one of the main reasons investors tend to sell at the wrong time over a period of time and fail to benefit from their investment. And a good understanding of this principle causes volatility to alleviate many fears. As an investor, volatility isn't a metric that you should be focused on. It's a measure of short-term price movement which shouldn't matter to an investor with a 5 to 10-year timeline. Traders, on the other hand, live off volatility. They need volatility to trade. They need the stock price to move up and down to trade. After all, you can't trade if prices aren't moving. So to really hound in this point, real risk lies with the investor. And that's a direct quote from Benjamin Graham. He was Warren Buffett's teacher. The Intelligent Investor is an excellent book. If you want to know how to invest on your own, you can go read that book and you're set. You will have read the source material of most of the investing tactics and insights of today. And volatility does not mean risk. Volatility simply means opportunity. Traders use it to make a lot of money, and investors can use it to time their entry points and really ramp up their investment gains. You're still looking at a 5 to 10 year time horizon, but you can use volatility to your advantage. So volatility does not equal risk. The risk lies with us as investors. The more we know, the less risk our investment will be, and the more we can use volatility to our advantage. All right, so here are the causes, some of the causes of volatility. Periods of expansion and contraction of new investment dollars into a stock due to effects of a volatile economy or changes in an analyst's economic outlook, anticipation of companies' earnings announcement, and finally, stock market. Finally, we have to remember that the stock market is emotional and it overreacts to movements of fundamentals of underlying businesses and seemingly unrelated in the company or the economy, and also hype. Maybe they just read about a stock in a newsletter and they think it's going to be the next greatest thing and they jump in. And you'll notice that the causes of volatility are very similar to what moves the markets, because the market as a whole has a measure of volatility as well. Volatility is just a measure of how things move up and down and how frequently and how fast they move up and down. So all of these factors push into how volatile the markets are, how much they move up and down, and then how volatile individual stocks move up and down. Oh, and quick insider tip, 3 out of 4 stocks tend to follow the market. So this is why using broad market indexes like the S&P 500 or the Dow Jones average is really helpful, because if you're investing in a stock, you'll know that you have a 3 out of 4 chance of it just following what the general market is doing. Fun fact. All right, so let's look at some more factors of what affects the day-to-day stock movements of the market. And you're going to find some of these are a little repetitive. We're just kind of diving deeper into different kind of economic insights, but I want to really hammer in the point that there is a lot that makes the market move. And if you're trading, you have a lot to look at. And different stocks react to different things, which is why some traders stick within what you pretty much a niche, trading different types of different sectors or different types of stocks, because that way they only have to look at 1 or 2 factors as opposed to trying to figure out why the whole market is moving. So every day, the stock prices seem to fly every which way like a roller coaster. One day the market's up, the next day it's sideways, the next way it's crashing down, and then it's back up again. The price fluctuations in the stock market basically depend on these important factors. We talked earlier about the factors that affect individual companies and price movements, such as earnings and analyst reports. And here we're going to examine some more general factors that tend to influence the market as a whole. This is important because 3 out of 4 stocks follow the general market. So first we have internal developments. All the developments, large and small, that can affect the price of a stock, including mergers, earnings, dividends, suspensions, and so on. Even the news development of a launch of a new product or new company can affect the stock market. For example, Apple announces a new product and its price pushes other tech companies' prices down. So this is to say, let's say LG comes out with a super new high performance TV that's like 6K. We're only at 4K at this time of recording, so who knows? Maybe by the time you're watching this, they've come up with 6K. And investors and traders are like, whoa, this is the greatest thing ever. So we're going to invest in this. And you know what? Samsung and Sony, they're kaput. LG's just won the TV market. So even though the news is only about LG, people will pull out of the other two to go to LG because they think LG is now the latest and greatest thing. So that's just one example of how internal developments of one company can sometimes affect other companies or an entire sector or part of the market. Next, we have world events. And these events are just events taking place around the globe. This is definitely the hardest to track. For any of you who've tried to keep up with what's going on in the world, it's crazy. You're trying to keep track of, a couple billion people. It's hard. So the events taking place within the doors of the company can be just as impactful as those, happening around the world. You have war, civil unrest, impeding government regulation, natural disasters. For example, negative news in the Middle East often, even if the oil company has no interest in the region, say company, or I'm not going to name individual countries here, but let's say country A is, suddenly has a new coup, and Exxon has interest in company C. I mean, even though they're a couple thousand miles apart, everyone looks on the news and they're like, oh no, they just kind of blow it. And this is, again, things are always blown out of proportion, and people are irrational when it comes to news. So even though country A has nothing to do with what's going on in country C, where Exxon is, Exxon might drop just because a couple thousand miles away, some bad stuff is happening. Next, we get to some more economic type stuff, which is inflation and interest rates. And inflation and interest rates tend to affect the stock market and stock prices directly. And this is one of the major disadvantages of stocks as a paper asset. Or I should say, increases in interest rates is normally followed by a sell-off in stocks as investors move from stocks to bonds as they just chase a better return, a better yield. Next, we have exchange rates. And if you're investing domestically, normally this doesn't really have a big factor playing on what you're doing. But foreign exchange rates can directly affect stock prices. When exchange rates increase or decrease, stock prices tend to fall and affect the market adversely when there's sharp movements with exchange rates. And finally, the strongest by far out of these 5 factors. And that's because it's normally a result of the other 4, and I've been hinting to it as we've been going through. And that is hype and fear. When a hot new company is having an IPO or a new product is launched, or just think about the dot-com boom, anticipation, excitement, and greed run the market. Anticipation, excitement, and greed run the market. These types of times of hype and fear are known as bull markets and bear markets, respectively, which we're going to discuss next. First, we're going to talk about bull markets. What is a bull market, and how do we deal with it? A bull market is characterized by a general rise in prices with the expectation that current growth will continue and increase into the future. This concept can also be applied to individual stocks as well as the market as a whole. For instance, if an investor believes that a stock price is on the rise and will continue to rise, they might say they are bullish because they think the stock price is going to keep going up, to signify they believe there's still room for the price to go. So how do we tell if market sentiment is bullish? So here are a couple of telltale signs. The occurrence of bull markets are normally preceded by investors confident and upbeat, while analysts' expectations are very optimistic. In the beginning, the increases in market prices may or may not be accompanied by strong corporate earnings or economic data, but prices will continue to increase on the assumption of continued growth. So stock prices will continue to go higher and higher and higher, even if there's no actual real-world results to support the new high levels of prices. So here's the best way to deal with these bull markets. The short answer is run. As an investor, run. As a trader, do your thing, get in, get out quickly, play your little games. But as an investor, you run. And bull markets almost inevitably turn into bubbles. And a bubble is simply an extreme bull market that gets out of control. And bull markets are always followed by a bear market, which is what we'll talk about next. Market bubbles such as the dot-com boom of the early 2000s, the mortgage crisis of 2008, are both examples of what happens at the end of a bull market, and that's why you run. Since they always end in disaster, as an investor, you need to steer clear of the stock market when prices get out of control. As a trader, there are ways to take advantage of the madness of the market using techniques such as hedging and shorting, but these techniques are extremely advanced. And actually shorting during a bull market is really dangerous, but people still do it. But for both traders and investors, the money is made when the bull market crashes. For example, as a trader, you can make phenomenal returns as the market crashes by shorting stock, which we can talk about later. And as an investor, you make phenomenal returns purchasing stocks at their inevitable bear market lows. So whichever path you choose, you make your money when the crash happens, not during the giant run-up. Many fortunes have been lost by people who've tried to time the top of the bull market. Maybe they buy one day and they say, I know it's going up and I know it's going to crash, but maybe if I could just get in and out real quick towards the top, we'll make a bunch of money. And most of them get burned. Remember, over 90% of traders lose all their money. So unless you really know what you're doing, just don't play with it. Just be patient, wait for the thing to crash and burn, and then build up a great portfolio with awesome, low-priced, cheap stocks. Because even good companies go down with the ship. Remember, 3 out of 4 follow the market. It could have record earnings that year, and the stock price will still be down, and it makes a great buying opportunity. And that's what a bear market is. So how do we handle bear markets? Let's first rewind a little bit and go over the definition of what a bear market is. And a bear market is identified by a fall in the stock market for an extended period of time. It is the complete reverse of a bull market. The sharp decrease in stock prices may be due to a correction or overvaluation from a bull market or decline in corporate profits. Remember, we can be bullish or bearish on individual stocks as well as the stock market as a whole. A bear market normally starts with a sudden drop in prices, like the bursting of a bubble from a bull market. Bull bear. Panicking investors resort to selling stocks in large numbers on fears that the prices will continue to decrease. You can kind of see where this is going. As more investors join in on selling stocks, the price drops further, thereby starting a vicious cycle that pushes stock prices lower and lower and lower. So in such a case, here's how the best way to handle this without losing your shirt. The first thing we should remember is that a bear market is bad only if you need money immediately. And if you need money immediately, investing is probably not the first place you should be looking. The falling prices are just an indication of long-term results. Ideally, you want to hold your stocks during these bear market periods. And when I say they're indication of long-term results, you never know how long it's going to fall. It might bounce a couple times on the way down. And when I say bounce, I mean prices might go up a little bit, but when you're in a long-term bear market, prices normally just go down, 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 down. It might take a couple of years. And that's the other thing too. I mean, these things can last months, they can last years. You can have multiple cycles going on at the same time. But remember, we're just covering the basics here. So just get down, bull market up, don't invest, bear market down, time to invest. Understand the difference between stock prices and the underlying value of the businesses which they represent. As long as the business hasn't taken a turn for the worst, you can ignore the price drop and load up on great companies at a deep discount. When you come across the situation where you see the market is falling, as hard as it might be, it's actually the best time to buy, especially if you are in it for the long run. These bear markets are where fortunes can be made in the stock market, and you really don't have to be that clever or smart. I mean, this is where the market comes to you. Bear markets really are your best friend when it comes to investing, because great stocks become super cheap compared to their value, and you get excellent investment deals. Finally, we're going to wrap up with, do bulls and bears actually matter? The stock market is in constant movement between bull and bear markets. It's important to understand that there are multiple market cycles. There are cycles that last months, and cycles that last years, and cycles that last decades. We can come up with completely different conclusions about where the market is based on our time horizon. This is why it's so important to decide whether you're a trader or investor. As an active trader, we need to be very conscious and cognizant of the bullish and bearish behavior of the market. Obviously, it affects the overall trend of the market, which is vitally important because it will form a context for your trading decisions. As investors, on the other hand, since we aren't actively in the markets, we don't have to be as vigilant in understanding the current short-term market cycle. As an investor, your time horizon is in years and decades, and as such, we would want to be looking at larger market cycles that span years, as opposed to traders who are concerned about current market cycles that are just over a few months. Thank you for watching. I hope you found this informative and actionable. This concludes Module 2 of the Stock Market Foundations course. If you have any questions, please let me know in the comments section below. And don't forget to subscribe to my YouTube channel so you can stay up to date with the latest investment insights so that you can continue to maximize your investment returns. I'll see you in the next module. To your investment success.